All right, we are going to do the financial statements. That's what we're going to be doing today. All right, and we are also reminded that your assessments, I think they were supposed to open on the first, but I think it's opening on Monday. Am I right? And I also understand that although on my UNISA it says that you're going to have five assessments, but you're only going to do 4. So the assessment 4 will be the last one that you'll be doing. So we'll meet today and we'll meet again. I think next. I think I will see on Monday because my schedules are a little bit bad in terms of electricity. I'll see on Monday. I will check my schedules, then I will tell you how we will do it. Otherwise, if I see that at 6 I have load shedding, maybe I can push the class to 5 so that we do it earlier. Right. So I will be informing you because I think we need to meet on Monday. Then I need to do again financial statements. Then we also need to meet maybe on Saturday. Then I can do maybe non-profit making organizations. So I'll be informing you the program as we go. So I need us. So if all goes well, I need us to meet on Monday again, and I also need us to meet on Saturday again. I'll be telling you the program. All right. So now today, I want to do the statement of profit or loss and other comprehensive income. And please remember, if you're in ICU, remember to contact me anytime from Monday when the assessment is out. Right. The following information appeared in the accounting records of Mokala Traders for the financial year ended 30 September 2017. If you remember from our previous session, I gave you the layout for a statement of profit or loss. So I want to do it now. Prepare the statement of profit or loss and other comprehensive income of Mokala Traders for the year ended 30 September 2017. Please, this document I sent you some time ago. Right. So we'll have maybe let me do it here. We have our statements, profit or loss, and other comprehensive income. Of Mokala Traders for the year ended 30 September 2017. Right. Before you prepare your statement, it is advisable. Right. Normally they'll give you the trial balance and they'll give you additional information. It is advisable to read additional information and understand how you shall be treating that additional information. Right. On our additional information on number 1, we are told that the physical inventory count at 30 September 2017 indicated that inventory amounted to 128,100 and stationary to 3750. Right. The 128,100 is the closing inventory of our trading inventory. So it will be included in the calculation of the cost of sales. And the stationary inventory, if you see here on the list, the stationary here, 10,200. Now the stationary inventory, it means out of that 10,200, by year end, they still have unused stationary of 3,750. So when we record the expense of stationary, we should remember to take out the 3,750 because it has not yet been used. It will only be an expense in the future periods when it's actually used. So you should remember, stationary at the end of the period or consumables at the end of the period are supposed to be deducted from the related expense. Right. Number 2, a debtor that owes 1,800 must be written off as irrecoverable. That's a credit loss. So you check if there are credit losses on the list and then you add. So that means to these credit losses that we have here of 17,250, we also have to top up with the 1,800. So when we deal with credit losses, we should remember to add that 1,800. Right. Provide for depreciation as follows. This will be our depreciation expense. Right. Then it was determined that the allowance for credit losses account should amount to 21,450. Right. For the allowance for credit losses, it is also grouped together with the credit losses. But for the allowance, you have to check the change from last year to this year. An allowance for credit losses, it's reviewed every year. It is reviewed every year. So you check on the list, what was the allowance before the current year? You would see that our allowance for credit losses was 19,200. And you check what is the allowance this year. Our allowance is now 21,450. So it has gone up. That increase from the 19,200 up to 21,450 is the one that will be added in the credit losses. So you should remember, when we're doing the statement of profit or loss, in the credit losses, we only include the increase in the allowance. We add if it's increasing. And if it's decreasing, we subtract. So you have to check, compare the allowance on the list and the allowance to the additional information. And if there's an increase on our allowance from the one on the list to the new one, then that increase is what we add to the credit losses. And if it's a decrease, we subtract from the credit losses. Right. Wages amounting to 3,000 must still be paid. That means in these wages here that are on the list, let me look for wages here. Salaries and wages, 135,450. That means there's an amount of 3,000 which is not included, which belongs to this current year. So if they tell you that an expense must still be paid, you are supposed to top up that expense in your expenses. So we should include that 3,000 within our expenses. Right. Now the fixed deposit was made on 1 October at Investment Bank at an interest of 8% per annum. The fixed deposit here it is. When we are doing the profit or loss, we are not interested in the fixed deposit. We are interested in the interest. When you invest in a fixed deposit, you earn interest. Right. As long as, of course, they gave us the interest here, that is 6,000. But as long as you know the amount of the fixed deposit, that is the 105,000, and we know the interest rate, which is the 8%, and we know when the amount was invested, you should recalculate the interest. Why? You might find that maybe the one that is on the list, we only received the part of it. We didn't receive all the interest, or there was a prepayment. So please, on loans and fixed deposits, as long as you know the amount of the loan or fixed deposit, you know the interest rate, you know when the loan was taken or when the fixed deposit was made, don't just take the interest that you are given when you are doing the profit or loss. Recompute the interest. Why? Because the interest that is given, like here, what was given is what was paid. They might have paid less. They've not. Maybe they are still owing us some money, or maybe they paid more than our interest. So there's a prepayment. So that's why always for interest, as long as you know the amount invested and you know when it was made, you are supposed to recompute. But if you didn't know any of the things, that is the amount, the rate of interest, and when the investment was made, you can't recompute. So only if those three are given, that is the amount, when the investment was made, and the interest rate, then you should recompute. Right. So we're going to recompute that. The mortgage agreement was entered into on 1 August 2017 and bears interest at a rate of 10% per annum. The interest for the current year must still be accounted for. The same. The mortgage is just like a loan. So mortgages and fixed deposits are the same. As long as we know that when the investment was made, as long as we know the rate of interest and the amount of the mortgage, which is here, this mortgage here, then we should recompute even if it was given. So please always know that when you're doing the profit or loss for mortgage, loans, fixed deposits, the interest that you have to account for as long as you know the principal amount, you know when it was invested, and you know the interest rate. Please recompute. Don't just take the interest that is given. Right. Any questions on the additional information that I've just explained? We are going to show it when we do the profit or loss. Here I was just giving you an overview of how we treat them. Any questions? Right. So now we'll prepare our statement of profit or loss. Please go, those who were not there last week, you should refer to this sheet when I sent it to you. I gave you the layout here of the statement of profit or loss, whereby we know that we start from our revenue, and I described the revenue, sales, less sales returns, less settlement discount. Then you subtract your cost of sales, which includes all these things. You get your gross profit, then other income. Then we subtract the expenses. So that's the procedure that we're going to follow. So if you didn't attend last week, please make sure that you review the recording for last week and the notes, so that you can be able to understand how we prepare the statement of profit or loss. Right. So I will now prepare the statement of profit or loss, my friends. Please, if I'm too fast for you, say it so that we can be together. I don't want you to be left behind. Right. Our revenue is our sales, less sales returns, less settlement discount granted. It's already given here above there. It's given what I'm saying here. You can see it here. It's sales, less sales returns, less settlement discount. So that means before you record your revenue, check if there is sales returns, check if there is settlement discount granted. So we can see that our sales is given here and our sales returns, they follow each other. So we're going to subtract that sales returns, and we check if there is any settlement discount granted. We have the settlement discount granted here also. So we'll take our sales, subtract those two. So we're going to say our revenue is 1,350,600. That's our sales, minus our sales returns, which are 13,050, minus our settlement discount granted, which is 13,800. What do we get, my friends? Let's help each other so that we can be faster. When there's a calculation, let's just try to help each other. Those who have got calculators. I'm waiting for you, my colleagues.
Yes, we're calculating, sir.
Okay, not a problem.
I'm getting 1.323.750.
Thank you so much. Right. Then we subtract our cost of sales. Remember what I said, the cost of sales, it can be given. That is if they are using what we call the perpetual inventory system. Or sometimes it is not given if they are using the periodic inventory system. As you can see, in this case, it's not given. So we have to calculate. As long as we've got things like purchases and purchase returns, that means it's not given. So we have to calculate. Right, to calculate our cost of sales, we start with the opening inventory. The opening inventory is the inventory at the beginning of the year, which came from the previous year. Right. Usually it is on the list. There are two inventories, the opening and the closing. For you to see which one is opening, which one is closing, you look at the date. So if we check here, our date of the inventory is 1 October 2016. Remember, our year is ending on 30 September 2017. That means 1 October 2016 was the beginning of the year. So this is our opening inventory, the 217,950. Then the other one that I read on additional information one, the one on 30 September 2017, this inventory is the closing. So our opening will be the 217,950. So you have to check the dates for you to see which one is opening and which one is closing. But normally, the one on the list, trial balance, is the opening inventory, and the one on the additional information is the closing inventory. Right, then our purchases. Right, our purchases, we take the given purchases, subtract any purchases returns, and subtract any settlement discount received. So we take purchases, less purchases returns, less any settlement discount received. So I think I saw them that they are at the top, all of them, these three things. You should be very careful. On the purchases, we subtract settlement discount received, because that is the one that we receive from our creditors. Then on the sales, we subtract settlement discount granted. So our purchases is going to be 795,150 minus 5,900 minus 11,100. So we're going to say 795,150 minus 5,900 minus 11,100. What do we get?
I'm getting 768,150.
Right, so that's it. Then we also add any additional costs that are incurred when purchasing goods. These ones here. When you buy goods, you might need transport. Let's say you are buying from Mpumalanga, you might need transport to transport them to Pretoria. You might be buying from Zimbabwe, you might need import duty. There are also certain types that have got excess duty. So if we've got those additional costs, and for us to add them on the cost of sales, they should be on purchases. They should be on purchases, not on sales. So we have to check if we've got such additional costs on purchases. Right. So if we check on our list here, let us just check carefully to see if we've got anything. But I don't see anything on purchases there. But if there was carriage on purchases, freight on purchases, import duty on purchases, customs duty on purchases, we're going to add them. But we don't have such things here. Right. So then if we don't have, then we go straight to deducting our closing inventory. If we don't have those things, then we deduct our closing inventory. You should remember that our closing inventory is subtracted. Our closing inventory is subtracted. Right. So our closing inventory, we have it on additional information number one. Our inventory was 128,100, not the stationery. We don't include stationery, consumables, or packaging material. So that's the 128,100. So we'll have right. This will give us our cost of sales. So that cost of sales, that 858, I got it by taking the opening inventory plus purchases minus the closing inventory. That's how I got the 858. And we will subtract it from the revenue. Right. Then we'll get what we call our gross profit. Gross profit is the revenue less cost of sales. So it's this 1323 minus the 858. So that is equal to this minus that one. That's our gross profit. Any questions so far?
All clear, sir.
Okay. Right. Then after the gross profit, we then add what we call other income. Right. The main income of a business is the revenue. If it's a school, is the revenue is the fees that comes from students. If it's ShopRite, the revenue is the sales that they make. If it's DSTV, is the subscriptions. Those are the revenues. But on top of the main revenue, a business may have other things that also bring in income. For example, ShopRite might have additional space which they are not using at their premises, and they can rent it out, then they receive rent. They might put money in a fixed deposit and earn interest. They might sell airtime on behalf of a cell phone companies, MTN, Vodacom, and then they can receive commission. They can be what you call credit losses recovered. They can sell a delivery vehicle that is old and earn a profit, the profit on the sale of the delivery vehicle. So all that is other income. So we check if we have other income here. Already we have that interest on the fixed deposit, but we check if we've got any other, right? If I can check here on the list here, I think the only in other income that we have is interest on fixed deposit. And remember what I told you, although they gave us this 6,000, as long as we know the amount of the fixed deposit and when it was invested, it was invested at the beginning of the year. Why do we need when it was invested? Because if it was invested 2 months ago, it will not earn interest for the full year. It will only earn interest for 2 months. That's why we need when it was invested. So this one was invested on 1 October 2016, which was the beginning of the year. So it will earn a full year's interest. Then the interest rate, we know it's 8%. And we know the amount of the fixed deposit, which is given here, 105,000. So we're going to say 8% times 105,000. So we have interest on fixed deposit, which will be 105,000 times 8%. What do we get?
You want the interest amount, say?
Yes.
It's 8,400.
8,400. So you see,
Yeah.
although on the list we have list or the trial balance we've got 6,000, but our interest is 8,400. That means they still owe us the other 2,400. But the fact that we've already invested the money, we're already entitled to it. Remember that when we're preparing financial statements, we use what we call the accrual basis. If a tenant stayed in your room for the past year and he didn't pay you, the fact that he's already owing you, you record the rent as income. So the fact that we already invested the money, they are owing us the other 2.4, we record the full amount of 8.4 as interest. So please remember, whenever you've got a fixed deposit or a loan, as long as you know the amount, when the investment was made, the interest, don't just take the interest on the list when you're doing the profit or loss. Recompute. Right. So remember, that is the only other income that we have. Even if it's 1, we find our total. Right. Then we get what we call total income. All right, any questions? Total income is the gross profit plus other income. Total income is gross profit plus other income. Right. After getting your total income, you then subtract expenses. our operating expenses are divided into two categories. We have got what we call administration, distribution, and other expenses. Right. All expenses fall under this category except interest expense. And those that we have already included in cost of sales, that is the purchases. So we're saying all expenses fall under this category except interest expense. Right. So we'll have to take all expenses on the list. And then those that have got additional information, you should remember to take the additional information into account. We have water and electricity, 34,800. There's no additional information, so you take it as it is. Water and electricity, 34,800. Please, guys, if I leave out something that you think should have been included, say it so that we can be able to correct each other, or so that I don't have to leave anything out. Okay, it's possible that I can leave something out. Right. Then we have salaries and wages, 135,450. But remember, there's an adjustment. We have to add the wages that are amounting to 3,000 that are still to be paid. So if there are any expenses still to be paid, we have to add them. Salaries and wages, which will give us 135,450 plus 3,000, which will give us 138,450. Any questions there? Right. Then we have telephone expenses, 23,850. No adjustments. Telephone expenses, 23,850. We have stationery, 10,200. Remember, there was stationery on the end of 3,750, which has to be subtracted. There was stationery on the end of number 1, 3,750, it has to be subtracted. So if there's any stationery on the end, you subtract. What do we get?
$6,630.
Thank you. We have repairs and maintenance, no adjustment, to 850. Repairs and maintenance, 850. We have insurance, no adjustments, 19,800. Remember that if it's insurance on purchases, it will go in the calculation of cost of sales. Insurance on purchases will be included in the calculation of cost of sales. We have credit losses. Right now, here there's a story here. Remember that our credit losses, they are 17,250. We also have to add a data of 1,800 that has to be written off. Then let's not forget our allowance, which is going to increase from 19,200 to 21,450. That increase is supposed to be included also in credit losses. So we're going to have credit losses $17,250 plus additional information number 2, 1,800 plus the increase in the allowance, that's 21,450. The new allowance on additional information 4 minus the allowance on the list, which is 19,200. If it was a decrease, instead of adding, we're going to subtract. What do we get?
I'm getting 21,300.
Thank you. Then we have our depreciation here. Depreciation is also an expense. That is 11,250 plus 100,500. What do you get?
One, 2, 3, 750.
Right. Those are our admin, distribution, and other expenses. Is there anything that you see and you feel that we left it out? Or do you have any questions on this admin, distribution, and other expenses?
Sir, can we please amend the stationery amount? I give you an incorrect amount there. It's 6450, not 6630.
6450.
Yes.
Thank you. Thank you. Right. Then we get our total of the admin expenses. That's 371,250. Right. Then we have finance cost. Finance cost is interest expense. Interest expense. So we've got interest on mortgage. Mortgage, remember, it's a loan. So you should know that when we are receiving interest, it's income, but when we're paying interest, it's an expense. So interest expenses, you don't group them with other expenses. You separately categorize them as finance cost. Right. So that is, we know that our mortgage is 720. And we're told here that interest is 10%. And it was invested on 1 August 2017. 1 August 2017, our year is ending September. So this mortgage has only been there for 2 months, August and September. So we should take the number of months into account. So we'd say $720,000 times 10% times 2 over 12, because it has only been there for 2 months. What do we get?
I'm getting 12,000.
12,000.
I'm not sure if
I think it's correct. Because 10% is 72,000 and a sixth of 72 is 12,000. That's very correct. Right. So we subtract it again. Right. Then we get our profit for the year. Right. Our profit for the year is the total income minus the admin expenses minus the finance cost. Right. Then we add other comprehensive income. In this case, it's 0. Then we get our total comprehensive income. Right. Remember that our other comprehensive income, like when land and buildings are revalued. So we don't have that in this case. So that would be our statement of profit or loss and other comprehensive income. Any questions? Right. Then also today, I would like to, okay, so here, let me just call it the statement of profit or loss. I also want to look at the statement of financial position so that on Friday we start on the statement of a financial position on Monday. Right. Statements of changes in equity. Let me change this. Just a second. Right. When we prepare our statement of changes in equity, let me just use this example. Not a complicated one. This one. Right. We start with the balance at the beginning of year. the balance at the beginning of year is the capital that was there at the beginning of the year. Right. So in this case, if you can check here, our capital on 1 October was 525,000. So that was 525,000. Then you add additional capital contributions. Additional capital contributions is the capital contributed by the owner. During the year. It can be money, it can be other assets, as we learned from our previous sessions, of which there's nothing like that in this case. So if it's not there, you don't have to include it. Then add profit for the year. Remember, our profit is 90 to 100. So we add our profit of 90 to 100. Or it can be less loss for the year. So if it's a loss, you subtract. We don't have a loss in this case. And you don't have to include it if it's not there. So those things that I put 0, if they are not there, you don't include them, but I'm just doing it so that you understand the format. Then let's drawings. Remember, drawings are any resources that are taken by the owner for personal use during the year. It can be money, it can be groceries, it can be furniture, whatever he takes for personal use. What all that the drawings were 37,500. So less 37,500. You get
So profit of the
Yes.
year, I think it's 19,900, not
Okay, thank you.
9,200.
Thank you so much.
Okay.
Thank you. Then you get your balance at end of year. That's your statement of changes in equity. So that's how we prepare the statement of changes in equity of a sole trader. Any questions?
All clear, sir.
Okay, if we don't have any questions, then on Monday we'll do the statement of financial position. Thank you so much. Enjoy your weekend and God bless you richly. And please, from Monday, we should attend to our last assessment. If there are any questions or if you need any assistance, feel free to contact me. Thank you so much and God bless you richly. Enjoy your weekend.
Thank you. Bye.